Welcome, everyone, to this comprehensive explainer on the Finance Act 2024 rules for corporate groups and consortia. I'm going to be taking a deliberate, patient approach today. We're going to carefully, methodically walk through Chapter 13 of your Business Planning Taxation Workbook. My goal is to make sure you are fully prepared and totally confident for your 2025 advanced taxation exams. There is a lot of nuance here, so take a deep breath, focus your attention, and let's begin.
Okay, let's dive into this syllabus. We are going to methodically break down these 5 complex areas of tax law today. We'll start with types of corporate groups, then move into group and consortium relief, followed by chargeable gains group rules. After that, we'll tackle transfers of assets and intangibles, and we'll wrap up with administration and stamp duty. Starting right off with Section 1, Types of Corporate Groups. Now, identifying the correct group structure is absolutely the foundational step in any exam scenario. Seriously, if you misidentify the group right out of the gate, all your subsequent calculations are going to be flawed. So we really must get this right from the start. Let's meticulously compare the different thresholds you need to memorize here. For group relief group, you need a rigid 75% direct or indirect economic ownership, period. But notice how that differs for a chargeable gains group. For that, you need a 75% direct holding, plus a greater than 50% effective holding. Meanwhile, a VAT group is completely different. It only requires greater than 50% common control. And finally, a consortium requires each member to own at least 5%, with the total equaling 75% or more. Keep these distinctions crystal clear in your mind. Moving on to Section 2, Group and Consortium Relief. Now that we know how to identify our groups, let's focus on the mechanics of actually sharing losses between these connected companies. Because honestly, this is where the real tax planning happens. So there are very specific types of losses that can actually be surrendered within a group. We're talking about current period trading losses, non-trading loan relationship deficits, or NTLR deficits, excess capital allowances that create or increase a trading loss, property business losses, and excess qualifying charitable donations. Now, I want you to write this down because this is a classic exam trap. Overseas members cannot surrender UK trading losses. No way. They can only surrender overseas permanent establishment losses, and even then, only if they haven't already been relieved overseas. Please do not fall for that trap. Let's move to and see how this builds. When you're calculating the absolute maximum loss a claimant company can take, you've got to follow a really strict step-by-step process. You always start with the total taxable profits of the claimant. Then, and this is absolutely crucial, you must deduct the claimant's own losses first. So current year and brought forward trading losses, then NTLR losses, and finally property losses. It's only after exhausting its own losses that you arrive at the maximum group relief claimable. Let's quickly touch on the administrative rules. It's very common for the claimant company to essentially pay the surrendering company for the loss. Well, intergroup payments up to £1 for every £1 of loss surrendered are completely tax neutral. They have absolutely zero corporation tax effect on either company. Also, punch this strict deadline into your memory right now. Claims must be made within exactly 2 years of the end of the claimant's accounting period. Don't miss it. Now, brought forward losses. They have much stricter rules, specifically those post-April 2017. The surrendering company can only surrender them if it literally cannot use them itself, and the claimant can only use them if it has no unused carry-forward losses of its own. And here is a severe restriction to keep in the back of your mind. If a company is purchased, there is a 5-year block. Post-April 2017, carry-forward losses cannot be surrendered for 5 years after that change in ownership. Okay, let's slowly read through the definition of a consortium. A consortium exists when 2 or more companies each own at least 5% of a UK company, and together they own at least 75%. But here is the critical part. No single member can own 75% or more. If any single member hits that 75% mark, well, it ceases to be a consortium immediately and just becomes a standard group. So how does relief actually flow here? Interestingly, it can flow in either direction. It can go from the consortium company to a member, or from a member down to the consortium company. However, it is strictly limited by the member's percentage of ownership. Also note the concept of link companies. If a consortium member is part of its own 75% group, it basically acts as a bridge, allowing relief to flow from the consortium company straight through to that larger 75% group. It's incredibly useful. Section 3, Chargeable Gains Group Rules. Let's completely pivot our lecture away from trading losses now and delve into the highly specific rules governing capital assets.
And this brilliantly illustrates the massive tax advantages of forming a gains group. The primary benefit, without a doubt, is the no gain, no loss, or NGNL, transfer. Assets move between group members automatically at their tax written down value. Furthermore, you can match gains and losses in the same company, and you can claim group rollover relief, which is where one company sells an asset and another company in the group reinvests the proceeds.
But what if you don't want to physically move an asset, but you still want the tax benefit? Well, this is where the reallocation election comes in. Groups can elect to conceptually reallocate a gain or a loss to another member. This is an absolutely essential tool for tax planning. You can use it to match gains and losses, keep profits below the threshold for quarterly tax installments, or simply move a gain into a company that already has available group relief to shelter it.
Right. Now I need to deliver a strict warning about the degrouping charge, or DGC. If a company leaves a gains group and it is holding an asset that it received via a no gain, no loss transfer, a charge arises. But only if that transfer happened within a specific window. You need to memorize this time frame. It is exactly a 6-year look-back window.
So how do we calculate this charge? The DGC essentially equals the exact gain that was avoided back at the date of the original no gain, no loss transfer. It's usually just added to the sale proceeds of the shares. But here is the crucial exam exception. If the substantial shareholding exemption, or SSE, applies to the disposal of those shares, the DGC is entirely wiped out. SSE covers both the share gain and the DGC. Section 4. Transfers of assets and intangibles. Let's transition over to the nuances of transferring specific classes of assets, like intangibles, between group companies. So just like capital assets, intangibles also transfer on a completely tax-neutral basis at their written-down value. But I really want to spend some extra time here warning you about PECL, pre-entry capital losses. These are basically unused capital losses in a newly acquired subsidiary. The rules strictly ring-fence these losses. They can only be used against gains on assets the subsidiary already owned when it joined the group, or assets it bought later from third parties. Why? Well, to prevent a wealthy group from simply buying up loss-making companies just to shelter their existing gains. Now, what's really interesting about this slide is how we handle assets that fundamentally change their nature during an intra-group transfer. Let's contrast them. If a capital asset is transferred and becomes trading stock, it transfers at no gain, no loss, but a gain arises for the recipient at open market value. However, the recipient can make a Section 161 election to use cost instead. Conversely, if trading stock becomes a capital asset, trading income arises immediately for the transfer at open market value, and there are absolutely no elections available. The tax outcomes are totally different. Finally, Section 5, Administration and Stamp Duty. We are now moving into the final section of our syllabus, where we will cover the administrative machinery and stamp taxes. For a 75% group, there are actually very generous stamp duty exemptions. The transfer of shares and securities is completely exempt from stamp duty, and the transfer of land and buildings is exempt from stamp duty land tax. However, take note of this warning. There is a strict 3-year clawback rule. If the receiving company leaves the group within 3 years of that transfer, those reliefs are clawed back by HMRC. Let's look at the cash flow logic behind group payment arrangements. This is available for 51% groups. They can essentially nominate one single company to make quarterly tax installments on behalf of the whole group. The brilliant logic here is that it solves the problem of asymmetric interest rates. It stops the group from paying a higher rate of interest on underpayments while at the same time receiving a lower rate on overpayments. But remember, all members do remain jointly responsible for the final bill. Okay, let's just pause for a second. What is the crucial takeaway number from all of this? 75%. Take a moment to really burn this number into your memory. Despite slight calculation differences, whether it's direct, indirect, or effective, 75% is the absolute most critical threshold to memorize for both group loss relief and chargeable gains groups. Seriously, if you remember one number from today, make it 75%. I want to conclude today's explainer by leaving you with a complex, provocative scenario question. If you acquire a subsidiary with massive pre-entry capital losses, how exactly will you structure your group asset transfers to legally navigate those strict PECL ring-fence rules we just discussed? I want you to think deeply about this scenario. It is exactly the kind of higher-level synthesis you are going to need to demonstrate on exam day. Keep studying hard, review all the material we covered, and I will see you in the next masterclass.